This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Rapid recovery. The Dow gains more than 300 points, but some say the reversal has come too far too fast, and the new worry is about stocks running back to records.
The race to $1 trillion. Tech companies are growing in value, and it's possible one could reach that milestone this year.
Tax scams. The IRS warns of new cons, and the agency says the schemes are getting worse. Those stories and more tonight on Nightly Business Report for Thursday, February 15th.
Good evening, everyone, and welcome. What a difference a week makes. It wasn't that long ago when stocks were making historic and stomach-turning drops. But in this market, that seems like ancient history. Stocks today posted their fifth straight day of gains despite a new report that points to a pickup in inflation. Interest rates also rose to multi-year highs, but investors didn't seem to care, and stocks soared. The Dow Jones Industrial Average advanced 306 points to close back above 25,000. The Nasdaq added 112. The S&P 500 was up 32. And just as the sell-off happened at breakneck speed, so did the recovery. Mike Santoli takes a look at whether the bulls are back to stay.
Is the ferocious five-day rebound rally in stocks moving a bit too fast? Or is this a rare V-shaped recovery from a nasty market correction? This is the unexpected debate investors are having now that the major indexes have reclaimed almost two-thirds of the 11% loss of the prior 2 weeks. Conventional Wall Street wisdom holds that steep pullbacks usually take weeks or more to recover after an initial bounce. The index is often slipping back to recent lows in what's known as a retest or a base building process. This pattern certainly could still unfold in coming weeks, but the chance for a quicker rebound toward the late January highs also can't be dismissed right now. For one thing, history says the faster the drop, the quicker it can be recouped. The recent tumble was the fastest double-digit correction from an all-time high in 80 years. Then there's the role of forced selling by funds that had bet on volatility staying low. These funds unwinding bad trades last week arguably sent stocks lower than they otherwise would have fallen in a routine pullback due to rising interest rates. This activity seems largely out of the way. Finally, the rise in bond yields that spooked stocks has slowed, allowing investors to come to terms with rates in a higher range in response to strong growth. None of this means the market will indeed escape the need for further downside tests as Wall Street frets over inflation, bond yields, and high stock valuations. But the action of the past few weeks seems to show that even after such a sharp sell-off, this bull market will not go quietly. For Nightly Business Report, I'm Mike Santoli.
So which stocks are solidly on the road to recovery? Our Dominic Chu did some digging.
While the stock market overall may still be a little ways away from getting back to record high levels, certain individual stocks have done a much better job of getting back to reclaiming some of their 52-week or better highs. So we took a look at the S&P 500. Turns out 93 members there are within 5% of getting back to those 52-week highs, or perhaps even record or multi-year highs at that level. 81 stocks within the S&P have hit their recent highs just so far this year-to-date period, and 13 of these stocks have hit them again just this week alone. So one of the names that really has done a good job of getting back towards those record high levels, VF Corporation, the apparel company, within about 0.5% or so of record levels. Defense contractors have fared very well in this recent bounce off the lows. Northrop Grumman, one of those stocks, only off by about 0.2% from its record levels. Tapestry, the company formerly known as Coach, the retailer, within about 1%. Exchange operator CME Group within about 1% as well. And a Dow component, big athletic apparel company Nike, within a couple of percent away from its record highs. So as we talk about where the biggest bounces have been, some big names have already gotten back to close to where they were before the recent sell-off happened. For Nightly Business Report, I'm Dominic Chu.
The tech sector was one of the best performing today, and for a little while, Amazon surpassed Microsoft as the third most valuable company. But that was short-lived, thanks to Microsoft's 2% gain. Of the biggest companies in the S&P 500, the top 5 are tech. Apple has the biggest market cap at $876 billion, followed by Alphabet, Microsoft, Amazon, and Facebook.
But which will be the first to reach that milestone, $1 trillion in market value? Joining us to talk about that is Daniel Ives. He's Chief Strategy Officer and Head of Technology Research at GBH Insights. All right, Dan, so we don't want to bury the lead here. Which one of those contenders is likeliest to hit $1 trillion first? Apple has a lead.
Yeah, we continue to firmly think it's Apple, and we do believe $1 trillion happens by the end of 2018. You know, we've definitely seen some sort of ups and downs with Apple, especially with the iPhone 10 demand. You've seen a hand-holding period over the last, call it, week. You know, when I look at that product cycle, 350 million upgrades that are up over the next 12 to 18 months, you know, I believe combined with the sum of the parts valuation, 300 billion buyback that we think's announced in April, that's the one that we're betting on in terms of the horse to hit the $1 trillion market cap first.
But you think Amazon actually has the most momentum. Why?
Yeah, I mean, if you look at Amazon right now, I mean, I also think Amazon does hit $1 trillion. I just think they're the second one to hit it. If you look at the consumer piece right now, you know, Prime members, you're up to 90 million, spending 25% year-over-year increase. And that's only, in our opinion, the third, fourth inning of this sort of consumer sort of opportunity for Amazon. Then separately, you look at the enterprise with cloud and AWS. They're really on the cusp, along with Microsoft, of really getting this massive secular trend that it's really an Amazon and Microsoft sort of race at this point. Some of the parts on Amazon, I continue to view that as a name 15-20% higher in terms of numbers, and I think that's one that investors continue to look at as a leader.
So we can say that we like Amazon, we like Apple. You would put fresh money, you'd feel comfortable putting fresh money in there. What about the other two, Microsoft and Alphabet? Are they also buys in your book?
Yeah, I mean, look, they're buys. I think you separate out. Microsoft definitely has more tailwinds just in terms of what's happening on that Nadella-led cloud upgrade cycle, you know, where you're really starting to see more enterprises move to cloud with Microsoft front and center. When you look at Alphabet, you know, I think this quarter was a little shaky that investors focus on, but ultimately you look at YouTube, you look at search, the monetization story continues to be alive and well. And look, you talk about tech stocks, the FANG-led recovery, you know, we are seeing no signs of that slowing down with Apple, the first to hit $1 trillion in our opinion.
Dan, thanks very much. Daniel Ives
Thanks
is
for
with
having me.
GBH Insights.
The nominee to head the Federal Trade Commission is open to possibly examining tech companies. In response to a question about the tech sector's size, scope, and control, Joseph Simons expressed a willingness to look at firms like Google or Facebook to see if they're abusing their power.
The place most likely to have antitrust problems is places that have market power, right? And so those are the places you want to look the most. Those are the places you want to make sure you're monitoring carefully and paying attention to. And if something is, some anti-competitive conduct is occurring there, that's where you get a big bang for the taxpayer's buck by enforcement in those areas.
And those comments came during Simons' Senate confirmation hearing.
To the housing market we go, where there is some bad news for buyers. Mortgage rates are now at a 4-year high. According to Freddie Mac, the 30-year fixed-rate mortgage hit 4.38%, and many experts say they are going to go higher from here. But that does not seem to matter too much to the nation's home builders, who remain quite upbeat about the outlook for their business. Diana Olick has more.
The nation's home builders seem unfazed by the sharp jump in interest rates this month, and there are several reasons why. Builder sentiment didn't move at all in February, as measured by the National Association of Home Builders Monthly Index. It is still up sizably from a year ago, though, and just slightly off a high in December. The reason for most of the optimism is the tax plan. The home builders chairman said the pro-business political climate that will strengthen the housing market and support overall economic growth. He didn't mention mortgage rates, which are up more than half a percentage point since the start of this year and continue to climb. Not only are builders benefiting from a better economy and rising wages, they're also reaping the rewards of a severe shortage of existing homes for sale. One mortgage broker told me if you don't have a contract with a builder, things are pretty slow. Builder expectations for sales over the next 6 months jumped to the highest level since the recession, even though buyer traffic was unchanged and current sales actually fell a little bit. We get another read on the housing market tomorrow when we find out how many new homes broke ground last month. The number is still running well below historical norms and way below the current demand as builders struggle with shortages of land and labor. For Nightly Business Report, I'm Diana Olick in Washington.
So how long can we expect builder sentiment to remain this strong? Will there come a point when higher rates dull that optimism? Here to discuss that is Lawrence Yun, Chief Economist at the National Association of Realtors. Nice to have you here, Mr. Yun. Welcome.
Good evening, and thanks for having me.
I guess that is the question, whether or not those high rates will take a toll on the builders. What do you think?
Well, the rates will go up even further towards the end of the year, possibly even closer to 5%. So that is already, people should anticipate that. But what is happening in the housing market currently is the massive housing shortage, not enough inventory. Whatever builders build, they are able to sell quickly. So that's where the optimism of the builders are arising, that the fact that the profits are rising, the days on the market for newly constructed home is about 3 months. Historically, it will be close to 5 or 6 months. So from builders, just build it and the clients will show up.
So why, apart from that new construction, Lawrence, why is inventory so low? Why aren't people listing their homes for sale?
The single-family housing starts last year in 2017 was scratching 800,000. Historical normal would be 1.2 million. So we have been underproducing in 2017, but also in 2016 and 10 years prior. So it's been a multiple years of underproduction, and now finally it's catching up. We don't have enough home in commensurate with rising population, job growth. The GDP will probably grow at 3% this year because of the tax stimulus plan that will be in effect. So the job market will still remain very strong. A rising population need more home, and we have been not building sufficiently.
What interest rate level do you think might be the one that cools this market down? I mean, it used to be 4%, then some people said it was 5%. When do you start to see people either pull back from trying to buy a home, or, they want rates to go back down? Is there a level that you watch?
I think there will be some shift in geography. I mean, we are already sensing that people living in very high-cost areas of California, they are moving to Oregon, they're moving to Idaho, Utah, and we will begin to see that trend continue into essentially people moving out of housing unaffordable area into affordable areas. So the rise in interest rate will have a play, but I think what is more important is to monitor the migration patterns of people. In our econometric models, we are looking at possibly a 6% mortgage rate as a tipping point when the home sale will begin to decline.
On that note, Mr. Yun, thank you very much. Lawrence Yun is with the National Association of Realtors.
Time now to take a look at some of today's big upgrades and downgrades. Salesforce's rating was raised to buy from hold at Jefferies. The firm predicts a 20% rally in shares driven by strong enterprise growth. The price target there increased to $132 a share. The stock up more than 3% to $113.12. Bristol-Myers Squibb saw its rating raised to overweight from equal weight at Morgan Stanley. The firm cites positive growth prospects for its immuno-oncology business. The price target lifted to $78 a share. The stock gained 5.5% to $68.98.
Expedia was added to the best ideas list over at Guggenheim. The firm cites healthy underlying fundamentals despite Expedia issuing disappointing guidance recently. The analyst maintains his buy rating on the stock and the $145 price target. Shares rose 2% to $102.23. The payment processor Square saw its price target raised to $43 over at Deutsche Bank. That firm expects Square to report strong fourth-quarter results later this month. The analyst is keeping his buy rating on the stock. Square up nearly 6% to $44.29.
And still ahead, tax season can be the most profitable time of the year for scammers. So how you can keep your money safe. The best performing stock in the Dow this year is Boeing. Despite recent volatility, shares are up roughly 20% since the 1st of January, and it follows a nearly 90% rise last year. The CEO says he's not surprised to see investors putting money into his stock.
I think what you're seeing now is the market is responding to what is fundamentally a very strong airplane market, aerospace market globally, and the fact that we're delivering on our commitments. We had promised production ramp up. We're now delivering on that ramp up. And you can see the profitability that's hitting the bottom line as well.
The second best performing stock in the blue chip Dow index this year is Cisco. Shares are up about 15% since January 1st and were bumped higher today after a strong earnings report, which we told you about last night. The company says it's moving billions of dollars back to the U.S., and much of it will end up in the pockets of investors.
There's several options we have. We've always talked about the fact that we would leverage this capital to reduce our share count, which we announced yesterday. Obviously, to continue our capital strategy of returning cash to our shareholders, we increased our dividend yet again yesterday. And then we also think we've left ourselves plenty of capacity to continue to deliver M&A that aligns with our strategy that we've laid out over the last 2.5 years.
Cisco's $25 billion buyback helped puts the total value of share repurchases this year at $170 billion, and that is the largest amount of corporate buybacks at this point in a year ever, and easily tops 2016's $147 billion.
Shake Shack serves up a solid quarter with a side of fries, and that is where we begin tonight's market focus. The burger chain reported profits and sales that surpassed estimates, but it issued disappointing revenue guidance for the entire year. The company also said it plans to open between 32 and 35 new restaurants this year, the largest number of openings in a year in the company's history. Shares initially lower in after-hours trading, but they did close up 4% in the regular session at 41.21. And after the bell, CBS said a rise in content licensing and distribution revenues helped the media giant beat street targets. As we've reported, CBS is talking to Viacom about a potential merger. Shares were volatile in after hours, but they finished the regular day up more than 1% to 56.74. The food distributor U.S. Foods reported better than expected revenue and earnings and gave an upbeat outlook for the rest of the year. This came despite rising commodity prices. Shares climbed 9% to 32.87.
Treehouse Foods issued disappointing revenue guidance for the year, despite reporting better than expected quarterly results. The food and beverage manufacturer plans to close one of its California plants. Shares of Treehouse Foods plunged 12% on the day to $37.48. Shares of the solar panel maker SunPower came under pressure today after that company reported a disappointing outlook late yesterday. The company cited challenges from the new U.S. tariffs that would hamper its sales growth. SunPower shares were off 1% to $7.39. And SunPower's competitor, SolarEdge, says it's not seeing a negative impact from the new tariffs and expects any potential impact to be muted. The company also reported quarterly results that beat analysts' estimates. Shares of SolarEdge popped 24% to $45.85.
Well, tax season is in full swing, and the IRS warns consumers now about a new scam that targets your tax refunds. And while this particular scam may be new, the story remains basically the same. The tax filing season is one of the most popular times for cyber criminals to steal your personal information and your refunds. Joining us to talk about these scams and what you can do to protect yourself is Caleb Barlow. He's Vice President of Threat Intelligence for IBM Security. Caleb, welcome. Good to have you with us. I am assuming that a lot of these scams present themselves in the form of emails, some of which may present themselves in the form of emails from the IRS. Does the IRS ever reach out to people by email?
No, the IRS is not going to reach out to you via email. In fact, they're more often than not going to use the classic old U.S. Postal Service. And of course, in a time where we're seeing lots of confusion around new tax regulations, we're likely to see a significant increase in spam associated with tax filing to try to lure you in.
Well, obviously, they want to get some of your tax information. What else are these thieves after?
Well, they're after your tax information. They're after really any personal information that can be used to mount an attack or to potentially file fraudulently on your behalf. You know, last year, IBM's X-Force threat researchers saw a 6,000% increase in spam associated with tax filings between December and February of last year.
What are some of the other scams that you're seeing, apart from the ones I sort of alluded to, which would be a purported email from the IRS?
Well, a very common thing we will also see this time of year that is affecting more of enterprises versus consumers is something called a business email compromise. So you might see an email that looks like it's maybe from the CEO, the CFO, or a corporate officer asking you to maybe send all of the company's W-2s to a specific address, or provide some other form of information that the bad guys can then use and harvest to file fraudulently on behalf of individuals that work there.
Is it better for a consumer to file electronically, or is it better to do it through the U.S. Postal Service? Does it make a difference in terms of protecting your personal information?
Well, I'll tell you what, that's a great question. And, you know, if this year's anything like last year, about 155 million tax returns will be filed. Now, 70% of which are looking for a refund. But here's where this gets interesting. About 58 million people will wait until after April 1st to file. So this is the real issue. It's not so much about how you file, it's how long you wait. Because if you wait until after April 1st, you're giving the bad guys all the way from the beginning of February to April to file fraudulently before you do.
So the bottom line there is file as soon as you get all of your 1099s and your W-2s, right, Caleb?
Yeah, that's exactly right. And the other thing you can do, for example, is sign up for a PIN from the IRS. Don't delay in filing, and really be vigilant with your email inbox. Don't click on those messages that are talking about savings on taxes, or maybe even be careful of even the white paper that's talking about how to explain taxes to you. Just go out and Google those things directly on the web versus clicking on that link.
I'm going to lock myself in a room between now and April 17th. Caleb, thank you, with IBM Security.
Thank you.
You bet.
And I guess don't file an extension. Coming up, a new twist on the old adage, shop till you drop.
President Trump has reportedly backed a 25-cent a gallon hike in the federal gasoline tax as a way to help fund his infrastructure proposal. That is the equivalent of a $27 billion tax increase annually on consumers, according to one estimate. It could wipe out about 60% of individuals' savings from the new tax law. The federal gas tax has not been raised since 1993.
A higher tax on gasoline would mean less money in consumers' pockets. That could hurt a retail industry that's already struggling. But some brands are finding some new ways to get shoppers excited again. Andrea Day discovered the secret to their success.
A rush to get in line at Supreme in New York City, the brand launching its spring collection.
It's probably the hottest brand right now.
And weeks before, a frenzy to get inside Ralph Lauren in Soho.
People get hyped about it and it creates the buzz.
The buzz? Ralph bringing back a popular line called Snow Beach, a limited collection of shirts, jackets, and sneakers.
It's iconic. When I was a kid, I always wanted that and I couldn't afford it.
It's called a drop, where a limited number of products are released to the public, sometimes without any official notice. So what creates this rush to buy? We sat down with Daniela Vitale, the CEO of Barney's New York.
For us, and Barney's has always been so good at this, how do we create something in the store that really is incredible?
For the luxury retailer, it was a recent initiative called The Drop at Barney's.
Not only exclusive merchandise, but we had a host of amazing designers, music. There were 10,000 people that came in that Saturday.
And she says 20% were new to the retailer.
What does the future look like?
I think that becomes a permanent part of our vernacular at Barney's.
Some retail exclusives are so hot, the sold-out goods are ending up on secondary markets, where they sell way above the original price.
This is an Akira collection that they dropped last year.
Victor Guzman is in the business of buying up limited edition streetwear dropped by the brand Supreme and reselling it at a profit. For him, Thursday mornings are set aside for Supreme. That's when the brand typically drops its new collections, and thousands try to score at the New York City store and online.
I'm on like 4 different computers.
How quickly do things sell out?
Seconds. Literally seconds.
And one of the most competitive secondary markets is for limited edition sneakers, where some resellers unleash computer bots or automated programs to buy shoes being sold online in the blink of an eye.
Sneaker bots, we know that the secondary market is going at about $1.5 billion.
Edu Safrudi is the co-founder of Perimeter X, the company specializing in preventing malicious bots.
In some cases, you see more than 90% of the checkouts or of the actual purchased items will be done by bots.
And there is a law in place making it illegal to use bots to buy tickets for events like concerts, but no law right now for buying retail like clothing. For Nightly Business Report, I'm Andrea Day.
Fortune has compiled its annual list of the best companies to work for, and it takes into account pay, benefits, and places that give employees a sense of purpose. Number 1 on the list, Salesforce. It encourages employee philanthropy, among other things. Second is Wegmans. The supermarket chain offers scholarships to its employees. Third on the list is Ultimate Software, which matches 401k contributions at 40% and pays all medical and dental costs.
Wow. All right, before we go, on Wall Street, stocks rose for the 5th straight day, and the Dow gained 306 points to 25,200. The Nasdaq added 112. The S&P 500 was up 32. Another roller coaster day. Okay, that does it for us tonight. I'm Sue Herrera. Thanks for joining us.
And thanks for me as well. I'm Tyler Matheson. Have a great evening, everybody. We'll hope to see you right back here tomorrow night.